Hey, how's it going? Today I'm going to be talking about discounting cash flow and what that is. Sometimes I do need to ask myself, is it better to watch those TikTok videos or talking about this kind of topics related to finance and perhaps make investments, right? Why don't do both, right? Discounted cash flow, DCF, is a financial valuation method used to estimate value of an investment, business, or an asset by forecasting its future cash flow and then discounting it back to their present value. It's widely used financial and investment analysts to determine the intrinsic value of investment and to make informed decisions about whether to invest in particular project or asset. Let's take a look at the key components of DCF analysis and what it include. Cash flow. DCF starts by estimating a future cash flow that an investment is expected to generate based on history, right? These cash flows can include revenues, expenses, taxes, and capital expenditure. What you need to do take everything into account. Would that be expenses, something like liabilities, or perhaps general maintenances, depending on what kind of investment into what kind of will that be equipment, where you're gonna be looking to invest that money in. It's important to make a realistic and detailed projection of each period into the future. Or if we were to take a look at a different example, perhaps property, and what kind of expenses that would include, and how you can project future earnings, how you're gonna rent that property, and what would be cycles. Would that be 10 months out of 12 where the property would be rented? How much would that be accounted to? And make some projections, right? Discount rate. The discount rate often refers to as a required rate of return, or discount rate is the rate used to discount future cash flow back to the present value. This rate reflects the time, value, and money and the risk associated with investment. It can vary depending on the riskiness of the investment and opportunity cost of capital. In other words, would your money work better in investing in different projects, not in that particular project, right? And how you would be able to determine that, as well as how you would be able to manage the rest. Uh, without getting too greedy, I guess. Either way, it's an interesting metric to have, right? Time period. DCF analysis is typically done over a specific time period, which is often referred to as a projection horizon. This period can vary depending on the nature of the investment and availability of information. Would that be for 4 years, 8 years perhaps? How many months until you would need to replace that asset or project, or what would be perhaps even better before entering into any project? What would be your exit strategy, and when you would close this project or that you are working on, and once you close that project, how long you want to get into that project, and how long you want to be there and get out, if anything, right? Don't forget that there's an exit strategy that you should account for. The result in the present value of all expected future cash flows. If we calculate present value is higher than the current cost of the investment, it suggests that the investment is potentially undervalued and may be a good opportunity. Conversely, if present value is lower than the current cost, It may indicate that investment is overvalued. I can think about some of that equipment, right, that a lot of farmers might be interested in investing into. Some of the equipment, even a large tractor that can potentially work on the field, right? And some of those tractor costs and all the equipment, or would that be hardware, perhaps software? What will those expenses be? How much? Just try to imagine to break apart this kind of project, right? How it can project and what kind of guarantees you would need to have before investing in a large. We talk about millions, right? No, but not necessarily that's a good starting point. Perhaps if you were to begin with something, perhaps smaller projects, there is a good book. It's called Next Door Millionaire, and how people do make investment choices when buying small things like furniture, right? Where would you shop for furniture? Would you be able to perhaps refurbish that furniture yourself? And would you is something that you were or interested of doing every 5 or 10 years, right? And then it's a good investment, right? Unless you buy furniture that you would throw away every 3 or 4 years just to have new things constantly. So what kind of investment that might be, right? So from something silly or perhaps not that worth of the attention, progressing into a larger project, and how your mindset would work, or even the shoes. Some of the people would buy leather shoes so they could be repaired or after certain periods of time, so not necessarily be thrown away. Some of the mindset that people will have, repair mindset, I guess. There's a lot of information in that book for those of you who are interested in return on investment based on how you're making purchasing decisions. Myself, I'm not perfect, but I'm just saying there's a lot of information there for those who are interested. Small things, right? And those details can add up to you perhaps making large investment decisions, to some of the equipment working on a farm. And would you yourself, would you be able to repair that equipment? If not, what would be the price of the person to come in? Would you be able to move that equipment? If yes, where would you need to move your large farming equipment on the main roads, right? Would that be 100 miles? Would that be 50 miles, right? And how much that will cost, as well as a professional who is able to work with that particular software would need, and what is that professional hourly rate. Where take into account how much that could save you in the long term just to break apart the full project, and how you can determine and what kind of guarantees you will need to have. For those of you who would like to learn more, I would highly recommend to purchase this book. In the book, I'm sharing a lot of information. It's a game strategy. I'm sharing a lot of information with regards to strategy and the mindset. Then launching your first business, and some of the research or information or mindset that you should have doing research and actually starting it, as well as if you already have existing business, if perhaps you are looking to ways to think about business, improve your existing business, or if you were to have some capital and you might be interested in investing in different businesses, there's information for that as well. And the way I'm structuring this particular information for everyone to understand, especially if you perhaps just starting out, so it's very easy and simple. Very difficult concept, but I made it easy to understand. You can find this book in the description below, as well as topic has it. DCF, or discounted cash flow analysis, is used in various financial applications, including valuating stocks, bonds, real estate or property, and businesses. However, it has its limitations, such as need for accurate cash flow projections and the sensitivity of evaluation of the chosen discount rate. Additionally, DCF analysis assumes that the future cash flow can be accurately predicted, which is not always the case. and overall, all the process can be challenging, especially for long-term projections of what you are trying to evaluate. Perhaps looking at the history, based on the history, depending on if you perhaps would like to assess your own business and you would perhaps would have more control over your own business and your own actions, or particular asset or equipment that you would like to invest in, and what would be projection of how that particular investment can generate and how much can generate for you in the future. Feel free to reach out to me if you have any questions. I'm always there. Constantly busy with new projects, but other than that, thanks for watching, and I'll see you next one.